Thanks for coming in, Rob. As you were coming here, I'm sure, you're just up the road, right? Yes. As you were coming here, the President of the United States, the 45th President, was busy tweeting, and I wanted to update you on what he said. So he says, quote, the talks with China are at a different level. The quote marks are obviously at a different level thing. Now, he says, let's see what the end product is. That's what you have to judge it by, which is a good thing. But then again, the president doesn't really, I was going to say think carefully in his words, but he's pretty liberal with his use of words, isn't he?
Yeah, Godfrey, what we like to do at Alexander Forbes Investments is maybe just pull back the lens a little bit. We get this constant back and forth between Donald Trump and Xi Jinping. And of course, what they're saying is impactful. But I think more important for us is kind of what the trend is. And the trend globally is towards weaker growth at a time when we've got low interest rates and already elevated levels of debt.
Yeah.
Policymakers haven't normalized policy properly over the previous cycle and probably more than one cycle. And that implies that they don't have the tools to try and paper over the cracks of weak economic growth as they might have in the past.
Yeah.
And so I think we're just seeing policymakers kind of resort to other tactics, like bigger than name policies, to try and get a little bit extra out of the economy. And maybe in times when growth wasn't so weak, you might have some sort of success, but given that both sides are doing the same thing, it's not really a good outcome. So I think the trend here for us is towards, we've focused more on that trend towards lower growth at a time when rates are already low and debt's already high. And we shouldn't get too optimistic or pessimistic about the trade wars because, I mean, the noise changes week to week and that can just get a little bit confusing. We've got to kind of stick to the trends. I think that's far more important for us and for our investors.
That's true. But isn't it also true, Rob, that the President of the United States is really rewritten the rule book by which a president behaves and conducts economic policy, to the extent where perhaps you guys also need to rethink how you build your portfolios and how you manage them in this particularly different environment, if you like?
Sure, no, I get you. I'm not saying we don't pay attention. I mean, Trump obviously does things a little bit differently, conducting policies some of the time on Twitter. Of course, that's different. But as I said, I still think that pulling back the lens is important to our framework. That still adds value from an analytical perspective rather than getting swept away in the news one week or the other, because the markets are up and the markets are down. We've got to understand what the real fundamental drivers are behind the scenes.
Absolutely. If I take that argument a little further, Rob, would I be correct in suggesting that perhaps the better way to look at this is to look at this post-November 2020? Because by then we will know whether President Trump is coming back or not.
Once again, you can do that. You could make political bets based on what you think the election outcome might be, but that's not really the game that we're in. I said we are more focused on what the trends are. What we see in the trends is weak economic growth, late cycle, at a stage when growth is already, where debt levels are already elevated and interest rates are low. We're getting numerous confirmations that we're in a late cycle period, and this implies that it's not a great time to be taking on massive risk to our clients' portfolios. And that's more important for us than trying to take a guess about what exactly the election outcome might be next year.
I'm not hearing the big R word out of you. I'm hearing weak growth. Is that what you guys are looking potentially, that the world economy will be able to avoid a recession, and that what we are witnessing, as you say, is just a slowdown in economic growth?
No, I don't mind talking about a recession. It's just, for us, sometimes that word comes across a little bit alarmist, and people take it a little bit binary one way or the other. And once again, that's not how we're trying to manage portfolios. The way that we look at it is clearly growth is weakening, and this is not a great time for risk. We've got to have some sort of defensive characteristic within portfolios to protect clients. And so, talking about a recession, I mean, clearly the probability has increased. But that's why I think sometimes I'm just wary of the word because people see it in such binary terms, and we don't want to scare people. It's about managing portfolios in a pragmatic way, taking account the various probabilities that are out there in the market.
Does that mean becoming a little more conservative or a lot more conservative in terms of managing those portfolios?
Yeah, so we are getting more conservative in terms of managing the portfolios, making sure that they are slightly higher allocations to to fixed income. Of course, it's tricky because
Yes.
we know globally that the yields are already so low.
I was going to say so.
It's a tricky time for capital allocators, but of course, I mean, it's our responsibility to make sure that the portfolios are adequately protected.
Absolutely. You've got to justify your fee, Rob. You've got to justify your fee. So I wanted to ask you, what does this all mean for us in emerging markets? So South Africa, we have seen in the last few weeks, months, some people suggesting that some of the pressure that we've been seeing is a re-rating or a repricing of South African risk because what do they say? They say a downgrade is a certainty. That's one side. I want to understand what that means for us in terms of our assets here. And then the second side is obviously the impact globally on emerging markets and some of the rejigging, if you like, that we have seen of our global indices.
Yeah. Well, I mean, maybe starting with emerging markets. I mean, we like emerging markets over the long term.
Sure.
We think the growth prospects are good there. We think the valuations are pretty good. But what we know is that long-term valuation doesn't necessarily play out over the short term. And in the short term, there clearly are risks. If the global economy is weakening, if liquidity is not particularly great, it's trending lower. The Federal Reserve, yes, they might be lowering rates, but they're not lowering rates aggressively yet. They're not conducting quantitative easing. So in the short term, it's still going to be a troubling time for emerging markets. So we're not adding to positions there. Looking for better opportunities in the future to add towards emerging markets.
Right.
Because we said we do see long-term value. We do like them as an asset class. Just in the short term, we've got to be cognizant of the risk that could take place.
Yeah. And where does South Africa sit within that basket? Because certainly there has been a little love lost, hasn't it?
Mm-hmm. Yeah. So I mean, South Africa does come with South Africa-specific risks, and I don't think all of those are out of the all in the price yet. And there still, of course, are downgrade risks. So I mean, at the moment, we still do, we kind of favor having slightly higher, offshore allocations in our major pension fund portfolios, to protect against the potential weakness that could come through in the rand and rand assets.
Right. And within that emerging market basket, are there specific cases where the value is so screaming that you guys would be thinking, no, these are the places to go to, and are there some places that you would say, no, these ones we won't touch? Are there any characteristics that you are saying that you define these decisions or for it to invest in?
Not particularly at the moment because of those.
Just the basket
because
of
because of the risks I noted to you earlier. I mean, I think of course you could take very opportunistic type investments when things blow out. For example, Argentina. But that's not really what not our focus at Alexander Forbes Investments, where we're looking primarily at the asset class holistically.
Yeah. So in that environment, is gold the new darling?
So I mean, I think we've
or cryptos?
I think we've got to pull back the lens, I guess, first of all, and to say what is that environment? That environment of low interest rates,
low growth,
and low growth, and the risk that interest rates fall even lower.
Right.
This is very unorthodox times, and I think first of all we've got to ask ourselves the question whether lower rates are really going to solve the problem, given we've already had such.
And is there enough ammunition to do so?
Well, I mean, there's clearly not much ammunition. I mean, there is some, but there's clearly not as much ammunition as there has been in the past. But as I said, we've got to ask ourselves the question, first of all, is it going to work? And then second of all, what are the unintended consequences on financial markets out there? And one of those unintended consequences out there is desire for assets like gold. Gold is a historical store of value. It's a non-interest yielding asset, which generally is a big detraction from gold. But when global interest rates are falling towards zero and in negative in some places, it reduces that opportunity cost.
Right.
And that clearly creates some sort of interest in this asset class. And so, yes, I mean, I think that there's potential for further gains in gold. And as I said, we've got to draw back the lens and ask ourselves, as I said, what are the primary drivers that are taking place here? And what does that mean? What does that mean about the global economy that so many investors are interested in this non-interest yielding asset class? That it is quite concerning.